Of course, coming at a time when we are seeing Asian stocks very close to erasing their 2021 gains when it comes to the MSCI Asia Pacific. So where are you seeing the opportunities?
Well, really across the board. And I think the key message from us is that the typical concern in May, I mean, there's this adage, sell in May and go away, which we're all very well familiar with. We think some of that weakness may have been front loaded. Typically May is a weak month, but actually if you look on a slightly longer term frame of 3 and 6 months, it turns out May is the third best month to invest in the region. So the decline that we had from the mid first quarter peak, actually peak was on February 17th, that took about 10% off the index as a whole, took much more off China, down about 18%. We've had a bounce, and now we're giving some of that back, given obviously the challenging tape in the US. But if you look at the broader fundamental picture, which is one of earnings recovering very, very consequentially, up 31% this year, 16 next on our numbers, and valuations that have come down to the mid 15 level from over 18 times in mid-February, we think the risk versus reward looks pretty attractive here.
What economies are you seeing? What markets are you seeing those opportunities? Because this GTV chart on the Bloomberg showing how Taiwan already went down through a key support. We are talking about stocks sinking the most in 14 months. Of course, this after we saw all of the optimism coming from their semiconductor business, coming from their very tech-heavy index as well, which perhaps is also what we saw in Korea as well.
Well, great and topical questions. So just taking Taiwan first, we've obviously, as you said, seen very significant sell-off, particularly yesterday when the market was down 9% intraday, but then closed down about 4%. But the market's overall down close to 10% from its recent high. It's a bit of a reversal of fortune, because Taiwan was actually the best performing market in the region, of 17% before its previous decline rather. There's a couple of interesting points that investors may not be aware of in Taiwan I think are worth pointing out. Number one is that the headline index is actually a little bit distorted by the very, very high concentration of TSMC, the largest stock, of course, which is now 45% of the index weighting for the MSCI Taiwan index. If you actually strip out TSMC, the rest of the market's trading after today's moves between 12 and 13 times earnings, which we think is actually quite attractive. Number two, what we've seen is that the outperformance of Taiwan so far has very much been driven fundamentally. If you look at the relative earnings revisions in Taiwan versus those for the rest of the region, earnings everywhere have been revised up. In Taiwan, they've been revised up the most. So it's really been an earnings-driven performance, not sort of so much a speculative-driven one. But finally, to the latter point, we see that retail investors had stepped in to a more consequential degree in Taiwan. Retail sentiment has cooled off in a lot of places. Recall last year it was very hot in Korea, but that's actually really cooled off. Taiwan's the only place where it's really been concentrated. And we think what we saw yesterday was a margin-driven retail position squaring sell down, which we think provides an opportunity for more longer-term fundamental investors.
Tim, we are just hearing from the Taiwan Financial Supervisory Committee saying that they would seek to stabilize the market if stocks drop irrationally. I'm not sure what their definition of an irrational decline really is, but you know, when you take a look at the fact that the Taiwan market is, what, 60% tech versus about 18% or less than 20% for the broader Asia Pacific, it's a pretty good argument for investors needing to diversify their portfolios at this time, right?
Well, yes. I mean, I think, again, we have to break things down. So we are constructive on the top stock, and we're constructive on semiconductors overall. And we think that there are still very, very strong continuing fundamental dynamics that will be driving semiconductors. So we're overweight that area for the region as a whole, which obviously includes Taiwan and also very critically Korea as well, given the heavy concentration of semiconductors there. We are very well aware that the tech space more broadly is more interest rate sensitive. I mean, the common term now used is longer duration, meaning that the stocks there, given their cash flows and current valuations, are more sensitive to interest rates. That long duration argument, however, is more telling in the sort of dream stock part of tech as opposed to what we might call profitable tech. So one of the key distinctions we've been making, and this is also true for our recommendations within China, is to be focusing on what we call profitable tech as opposed to more of the concept stocks, which are, of course, more vulnerable to changes in sentiment and also to changes in interest rates.
Tim, I have to ask, what is your inflation thesis at the moment? Is this, the next 6 months of transitory effects? Is the next 6 months just the first steps towards more permanent higher inflation? And how do you adjust for that, or how do you hedge for that in your investing strategy?
Yeah, it's a great and it's super topical question. And I'd say we're a little bit of both of what you've just asked. So certainly for the U.S. data, our U.S. economics team was out saying that there are clearly, visible elements of a transitory nature to the very high print that we saw. We've seen it in sort of the so-called reopening space. Used car prices are up a lot. We think that's both demand and also supply issue and so forth. So we think, and we've been expecting this, and also there's a very kind of low base effect. So a good deal of this has been expected. We think it is sort of the transitory effects of the reopening of the economy. All that being said, there's no doubt that inflation pressures are beginning to build, and the longer you have for example, the Fed deliberately behind the curve, as its stated intention is, the more that inflation pressures will be allowed to build. Now, the area that we are focusing on that will partly be driving it, but also to your question is a great hedge, is, of course, the commodity space, which we're very bullish on. We're overweight commodities. One of our top trade recommendations within Asia is to be overweight the so-called commodity cyclicals versus defensives. And we know that that's attractive on its own right, but it's also lagged behind the price movement in the underlying commodity complex. So we think there's a bit of catch up in the commodity equities versus what the underlying base commodities have done. So that would be a way that we would like to express that view of kind of building upstream price pressures. And also we think it's a great entry point for, to not just for a hedge, but also for a directional view.